Something that might surprise you: if I woke up tomorrow with nothing but $50,000 and had to build a retirement portfolio from scratch, I would not do what most people expect. I would not hunt for the next Apple or Amazon. I would not spend hours analyzing balance sheets and calculating intrinsic values. I would not try to time the market or find some hidden gem that Wall Street has overlooked. I would do something far simpler, something that almost anyone can replicate, something that would give me a high probability of retiring comfortably without the stress and anxiety that destroys most investors. I've been investing for over 70 years. I bought my first stock when I was 11 years old. I have built one of the largest fortunes in the world through careful stock selection and patient holding. But here is what most people do not understand: the skills and resources I have access to, the ability to analyze thousands of companies, the network of brilliant people I can consult, the decades of experience reading financial statements. These are not available to the average person. And more importantly, they are not necessary for the average person to build substantial wealth. If I had to start over today with $50,000 and the goal of building a secure retirement, I would take a completely different approach than what made Berkshire Hathaway successful. Because what works for a company with hundreds of billions in capital and a team of analysts does not work for an individual investor with $50,000 and a full-time job doing something other than investing. Today, I am going to show you exactly how I would build a $50,000 retirement portfolio from scratch. I am going to walk you through the specific allocation I would use, the exact investments I would choose, the strategy for adding money over time, and the psychological framework that would allow me to stick with this plan through bull markets and bear markets alike. This is not theoretical. This is what I actually recommend for my own family when I am gone. And by the end of this, you will have a complete blueprint you can implement starting today. Let me take you back to a conversation that shaped how I think about investing for regular people. It was back in the 1990s, and I was having dinner with a group of friends. One of them was a school teacher. She had been teaching for about 20 years and had managed to save roughly $40,000 in her retirement account. She asked me what she should do with it. She wanted stock picks. She wanted to know which companies to buy. She assumed that since I had made billions in the stock market, I could point her toward the next big winner. I told her something that surprised everyone at the table. I told her to put 90% of her money in a low-cost S&P 500 index fund and 10% in short-term government bonds. And then I told her to forget about it. Do not check it every day. Do not watch the financial news. Do not try to time the market. Just add money regularly and let compound interest do the work. She looked at me like I was holding back, like I was not giving her the real secrets, the stocks that were going to make her rich. But I was being completely sincere. That simple strategy, which requires almost no skill, almost no time, and almost no expertise, would serve her far better than trying to pick individual stocks or time the market. I know this because I have watched thousands of investors over the decades. The ones who try to be clever, who jump from stock to stock, who chase the hot sector of the moment, who panic and sell during downturns, they almost always underperform. The ones who pick a simple, diversified strategy and stick with it through thick and thin, they build real wealth. Not because they are smarter, because they are more disciplined. That school teacher followed my advice. She put her money in an index fund and kept adding to it every month from her paycheck. She did not panic in 2000 when the dot-com bubble burst. She did not panic in 2008 when the financial crisis hit. She just kept investing. When I saw her again about 15 years later, her portfolio had grown to over $300,000. Not because she picked great stocks, because she stayed invested and let time work for her. Now, let me give you the framework I would use if I were building a $50,000 retirement portfolio today. This framework has three core principles that guide every decision. The first principle is simplicity. The more complex your investment strategy, the more ways it can go wrong. Complex strategies require more monitoring, more decisions, more opportunities to make mistakes. Simple strategies are robust. They work in different market conditions. They do not require constant attention. and they are far less likely to be abandoned when things get scary. The second principle is low cost. Every dollar you pay in fees is a dollar that is not compounding for your future. Over a 30-year retirement horizon, the difference between paying 0.03% in fees versus 1% in fees can amount to hundreds of thousands of dollars. I have said it before and I will say it again. When someone promises you high returns, the only thing that is certain is their high fees. Low-cost investing is one of the few guaranteed ways to improve your returns. The third principle is consistency. The market will go up and the market will go down. There will be years when your portfolio gains 30% and years when it loses 20%. The investors who succeed are the ones who stay the course regardless of what the market does. They keep investing during downturns when everyone else is selling. They do not get greedy and overinvest during bubbles. They maintain a steady, disciplined approach year after year. With these three principles in mind, let me show you exactly how I would allocate a $50,000 retirement portfolio. The core of the portfolio, and I mean the vast majority of it, would go into a single investment, a low-cost total stock market index fund or an S&P 500 index fund. I would put $45,000, 90% of the portfolio, into this one investment. Now, let me explain why this single decision is so powerful. When you buy a total stock market index fund, you are buying a small piece of every publicly traded company in America. You own a slice of Apple, Microsoft, Amazon, Google, Johnson & Johnson, Procter & Gamble, Coca-Cola, and thousands of other businesses. You are not betting on any single company succeeding. You are betting on American business as a whole, continuing to grow and generate profits. This is one of the safest bets you can make over the past century through world wars, depressions, recessions, pandemics, and every other crisis imaginable. American businesses have continued to grow. The stock market has returned roughly 10% per year on average over long periods. Some years much more, some years much less, but over decades that average holds remarkably steady. By owning the entire market, you eliminate company-specific risk. If one company goes bankrupt, it barely affects your portfolio because you own thousands of others. You do not have to worry about picking the wrong stock or missing the next big winner because you own them all. You participate in the growth of the entire economy without having to predict which specific companies will lead that growth. The specific fund I would choose is Vanguard's Total Stock Market Index Fund or their S&P 500 fund. The expense ratio on these funds is 0.03%. That means for every $10,000 invested, you pay $3 per year in fees. That is essentially free. You cannot find a more cost-effective way to own a diversified portfolio of stocks. Some people ask me why I recommend the S&P 500, specifically when I have spent my career finding undervalued individual stocks. The answer is simple. I have spent 70 years developing the skills to analyze businesses. I read 500 pages a day. I understand accounting, competitive dynamics, and management quality at a level that comes from decades of full-time practice. Most people do not have the time, interest, or inclination to develop these skills, and they do not need to. The data proves this conclusively. Over the past 15 years, more than 90% of professionally managed large cap funds have underperformed the S&P 500 index. These are funds run by people with MBAs from top schools, teams of analysts, sophisticated computer models, and access to company management, and they still cannot beat a simple index fund after fees. If the professionals cannot do it consistently, why would an individual investor think they can? Now the remaining 10% of the portfolio, $5,000, I would put into short-term treasury bonds or a treasury bill fund. This serves several purposes. First, it provides stability. When the stock market drops 30%, which it will at some point, your bond allocation will hold steady. This reduces the overall volatility of your portfolio and makes it psychologically easier to stay invested during downturns. Second, it provides liquidity for rebalancing When stocks drop significantly, you can sell some bonds and buy more stocks at lower prices. When stocks rise significantly, you can sell some stocks and buy more bonds. This systematic rebalancing forces you to buy low and sell high without having to make emotional decisions. Third, it provides a small cash reserve for true emergencies. While I recommend having a separate emergency fund outside your retirement portfolio, having some stable assets within the portfolio provides additional security. The specific fund I would choose for this allocation is Vanguard's short-term Treasury fund, or simply buying Treasury bills directly through Treasury Direct. The key is keeping the duration short, meaning 1 to 3 years, so that interest rate changes do not significantly affect the value. So there you have it, the complete portfolio, $45,000 in a total stock market index fund, $5,000 in short-term treasuries, 2 funds. That is it. No complexity, no fancy strategies, no market timing, just broad diversification, rock bottom costs, and the patience to let compound interest work over decades. Now let me address the objections I always hear when I share this approach. The first objection is that this seems too simple. People think there must be something more to building wealth. There must be secret strategies that the rich use. There must be some edge you can gain through research or timing or clever tactics. I understand this instinct. We want to believe that effort equals results, that the person who works harder and researches more will do better. But in investing, the opposite is often true. The more you trade, the worse you do on average. The more complex your strategy, the more fees you pay, and the more mistakes you make. The investors who do best are often the ones who do the least. Charlie Munger, my partner of over 60 years, used to say that the big money is not in the buying and selling, but in the waiting. He was right. The power of this simple strategy comes not from any clever tactics, but from the relentless compounding of returns over time. 10% per year does not sound exciting in any single year, but over 30 years, it turns $50,000 into over $800,000. Over 40 years, it turns $50,000 into nearly $2 million. That is the magic of compound interest, and it requires no skill whatsoever, just patience. The second objection is that 90% in stocks seems too aggressive, especially for someone approaching retirement. And I understand this concern. Stock market volatility can be stomach-churning. A 30% drop means your $50,000 becomes $35,000. That is a $15,000 loss on paper. For many people, that kind of volatility is psychologically unbearable. Here's how I think about this. The allocation I have described is a starting point for someone with a long time horizon, at least 10 to 15 years until they need the money. As you get closer to retirement or into retirement, you should gradually shift the allocation toward more bonds. Maybe 70% stocks and 30% bonds by the time you retire, maybe 60-40 or even 50-50 if you are very conservative. But I would caution against being too conservative too early. The biggest risk for most people is not stock market volatility. It is not having enough money in retirement. If you are too conservative with your investments, if you keep most of your money in bonds earning 3 or 4%, you may not accumulate enough to maintain your lifestyle for a 30-year retirement. Some risk is necessary to achieve adequate growth. The third objection is that this approach requires no skill, so anyone can do it. People say this as if it is a criticism, but I view it as the greatest strength, a strategy that anyone can follow regardless of their education, background, or investment expertise, is a strategy that can help millions of people. I would rather give someone a 90% solution that they can actually implement than a 100% solution that requires skills they do not have. The fourth objection is about market timing. People ask whether they should wait for a crash to invest or whether now is a good time to put money in. Let me be very clear about this. I do not know if the market is going to go up or down over the next year. Nobody does. Anyone who tells you they can predict short-term market movements is either deluding themselves or trying to delude you. What I do know is that over long periods, the market goes up. If you are investing for retirement that is 15 or 20 or 30 years away, the short-term movements do not matter. What matters is staying invested, continuing to add money, and letting time do its work. The best time to invest was 20 years ago. The second best time is today. Now let me talk about something equally important as the initial allocation: how to add money to this portfolio over time. Because $50,000 is a good start, but consistent contributions are what really build wealth. Here's what I would do. I would set up automatic monthly contributions to the portfolio. The amount depends on your income and expenses, but I would aim for at least $500 to $1,000 per month if possible. This money would go entirely into the stock index fund, maintaining the overall allocation roughly at 90% stocks and 10% bonds. The power of these regular contributions is enormous. If you start with $50,000 and add $500 per month at 10% annual returns, after 30 years you have over $2.3 million. If you can manage $1,000 per month, you end up with over $3.8 million. These are life-changing amounts of money, and they come not from clever stock picking, but from consistent saving and patient investing. This approach is called dollar cost averaging, and it has a beautiful psychological benefit. When the market is high, your monthly contribution buys fewer shares. When the market is low, your monthly contribution buys more shares over time. This averages out to a reasonable cost per share. Without you having to make any decisions about timing, you just invest the same amount every month, regardless of what the market is doing. I cannot stress enough how important automation is to this process. Do not rely on your willpower to make investments every month. Set up automatic transfers from your bank account to your investment account. Make it happen without any action required on your part. The less you have to think about it, the more likely you are to stick with it. Let me also address what accounts to use for this portfolio. If you have access to a 401k through your employer, especially one with matching contributions, that should be your first priority. Employer matching is free money. If your employer matches 50% of your contributions up to 6% of your salary, and you do not contribute at least 6%, you are leaving money on the table. That match is an instant 50% return on your investment. You will never find a better guaranteed return anywhere after maxing out any employer match. The next priority is typically a Roth IRA. The Roth allows your investments to grow tax-free, and you pay no taxes on withdrawals in retirement for someone who expects to be in a higher tax bracket in retirement or who values the flexibility of tax-free withdrawals. The Roth is incredibly powerful. If you have maxed out your 401k and Roth IRA contributions, additional savings can go into a regular taxable brokerage account while you will pay taxes on gains in this account. There is no limit to how much you can contribute, and you have full flexibility on when and how to access the money. Regardless of which accounts you use, the investment strategy remains the same. Low-cost index funds, 90% stocks, 10% bonds, automatic contributions, patience. Now, I want to share something about the psychological side of this strategy because this is where most people fail. The strategy I have described is simple to understand but difficult to execute. Not because it requires any skill or knowledge, but because it requires emotional discipline that most people lack. When the market crashes, and it will crash, every instinct in your body will tell you to sell. You will watch your portfolio drop 20, 30, even 40%. The financial news will be apocalyptic. Experts will be predicting further declines. Your friends and family will be panicking. Every fiber of your being will scream that you need to get out to protect what you have left, to stop the bleeding. This is exactly when you need to do nothing. Or better yet, keep buying. The investors who sell during crashes lock in their losses and miss the recovery. The investors who stay invested, who keep contributing their $500 per month, even when the market is down 30%, they buy more shares at lower prices. They benefit enormously when the market recovers. I have seen this pattern play out dozens of times in my 70 years of investing. The crash of 1973 and 74, Black Monday in 1987, the dot-com crash in 2000, The financial crisis in 2008, the COVID crash in 2020, every single time, investors who panicked and sold regretted it. Every single time, investors who stayed the course came out ahead. Let me tell you about someone I will call Margaret. She retired in 2007 with about $400,000 in her retirement account. Her financial advisor had put her into a diversified portfolio of index funds, roughly 70% stocks and 30% bonds. Then 2008 happened. Her portfolio dropped to about $250,000. She called her advisor in a panic, wanting to sell everything and move to cash. Her advisor talked her off the ledge. He reminded her of her long-time horizon, that she was 65 and might live another 25 or 30 years. He reminded her that she had a pension and Social Security covering her basic expenses, so she did not need to sell her investments. He convinced her to stay the course. It was not easy. For the next year, every time she checked her portfolio, she felt sick, but she did not sell. And by 2012, her portfolio had recovered to where it started. By 2019, it had grown to over $700,000. If she had sold at the bottom and moved to cash, she would have locked in a $150,000 loss and missed the entire recovery. The lesson is simple but profound. The biggest threat to your retirement portfolio is not market crashes. It is your own behavior during market crashes. The strategy I have described only works if you can stick with it through the scary times. And the simpler your strategy, the easier it is to stick with. This is one reason why I recommend such a simple portfolio. When you own just two funds, a stock index and a bond fund, there is nothing to tinker with. There are no individual stocks to worry about. There are no sectors to analyze. There is no temptation to chase the hot fund of the moment. You just own the whole market and wait. Compare this to someone who owns 30 individual stocks, several sector funds, some international funds, a few bond funds, and maybe some alternate investments. When the market crashes, they have to make decisions about each holding. Should they sell this stock or that one? Is this sector going to recover faster than that one? The complexity creates more opportunities for mistakes, more opportunities to let emotions drive decisions. Now let me synthesize everything I have shared and give you the core principles that make this strategy work. First, own the whole market through low-cost index funds. This eliminates the need to pick winners and losers. It eliminates company-specific risk. It guarantees that you will participate in the growth of the economy without having to predict which specific companies will drive that growth second. Keep costs as low as possible. Every dollar in fees is a dollar that is not compounding for your future. Over long time periods, small differences in expense ratios compound into enormous differences in final wealth. There is simply no reason to pay 1% or 2% for active management when index funds charge 0.03%. Third, automate everything. Set up automatic contributions, set up automatic dividend reinvestment. Remove yourself from the decision-making process as much as possible. The less you have to think about your investments, the less likely you are to make emotional mistakes. Fourth, stay the course through volatility. The strategy only works if you stick with it. This means not selling during crashes. It means not chasing hot sectors during bubbles. It means maintaining the same disciplined approach year after year, decade after decade, regardless of what the market is doing. Fifth, think in decades, not days. The short-term movements of the market are noise. What matters is the long-term trajectory, which has been consistently upward for over a century. If you are investing for retirement that is 20 or 30 years away, today's headlines simply do not matter. And let me close with some practical steps you can take starting today. If you have $50,000 to invest, open a brokerage account at Vanguard, Fidelity, or Schwab. These are all excellent low-cost providers. Purchase $45,000 of a total stock market index fund or S&P 500 index fund. Purchase $5,000 of a short-term treasury fund or treasury bills. Set up automatic monthly contributions of whatever amount you can afford. Even $100 per month is better than nothing. The amount will grow over time as your income grows. Resolve to never sell during a downturn. Write yourself a letter now, while the market is calm, reminding yourself why you are invested for the long term. Read that letter when the market crashes and you are tempted to sell. Check your portfolio once a year at most. More frequent checking just invites emotional decision-making. Rebalance once a year if your allocation has drifted significantly from your target. That is it. That is the entire strategy. It is not complicated. It is not exciting. It will not make you rich overnight, but it will build real lasting wealth over decades. It will provide security in retirement, and it will do so without requiring any special skills, any market predictions, or any luck. I have made billions of dollars through careful stock selection over 70 years. But if I had to start over today with $50,000 and the goal of a secure retirement, I would not try to replicate what I did at Berkshire. I would follow the simple strategy I have just described, because it works, because anyone can do it, and because the best investment strategy is not the one that generates the highest theoretical returns. It is the one you can actually stick with for decades. Now let me share a few additional insights that will help you implement this strategy successfully and avoid the common pitfalls that derail so many investors. First, let me talk about the role of international stocks. Some people ask whether they should diversify beyond U.S. stocks into international markets. It is a reasonable question, after all. There are thousands of great companies outside the United States. Why limit yourself to American businesses? Here is my view. While international diversification is not wrong, I do not think it is necessary for most American investors building a retirement portfolio. The largest U.S. companies already derive significant revenue from international operations. When you own Apple, Coca-Cola, or Microsoft, you are already participating in global economic growth. These companies sell products and services around the world. Additionally, international funds typically have higher expense ratios than domestic index funds. They also introduce currency risk and political risk that domestic funds do not have. The U.S. stock market has historically delivered excellent returns over long periods. Adding international exposure adds complexity without necessarily adding returns. That said, if you want to include international stocks, a reasonable approach would be to put 20% of your stock allocation into a total international stock index fund. So instead of $45,000 in U.S. stocks, you might put $36,000 in U.S. stocks and $9,000 in international stocks. This is perfectly fine. It is not what I would do personally, but it is not wrong. Second, let me address the question of individual stock picks versus index funds more thoroughly. I know that some of you are thinking, but you made your fortune picking individual stocks. Why should I settle for average market returns when you achieve so much more? Let me be very direct about this. The returns I achieved at Berkshire Hathaway are not replicable for individual investors. I had advantages that you do not have. I could buy entire companies outright. I could negotiate special deals and preferred stock arrangements. I had access to management teams and information that regular investors cannot get. I could move markets with my purchases and sales. And I had 70 years to develop skills that took full-time dedication to acquire. Even with all those advantages, there were long periods when Berkshire underperformed the S&P 500 index. It is not easy to beat the market consistently. And for every successful stock picker like me, there are thousands who tried and failed. You do not hear about the failures because they do not write books or give interviews, but they exist in far greater numbers than the successes. The index fund approach I am recommending is not about achieving the highest possible returns. It is about achieving reliably good returns with minimal effort, minimal cost, and minimal risk of catastrophic mistakes for building a secure retirement. And if your liability matches more than maximum performance, third. Let me discuss rebalancing in more detail. I mentioned earlier that you should rebalance your portfolio once a year if your allocation has drifted significantly from your target. Let me explain what this means and why it matters. Suppose you start with 90% stocks and 10% bonds. After a year of strong stock market returns, your allocation might have shifted to 93% stocks and 7% bonds. Rebalancing means selling some stocks and buying bonds to get back to your 90-10 target. This feels counterintuitive. You are selling the asset that did well and buying the asset that did poorly. But this discipline forces you to buy low and sell high systematically. It prevents your portfolio from becoming too aggressive during bull markets and too conservative during bear markets. Over long periods, regular rebalancing can add meaningful returns while reducing risk. I recommend rebalancing only when your allocation has drifted by 5 percentage points or more from your target. So if you target 90% stocks and you are at 94%, rebalance. If you are at 92%, leave it alone. This prevents excessive trading while still maintaining your intended risk level. Fourth, let me talk about what to do as you approach retirement. The 90% stock allocation I described is appropriate for someone with a long time horizon, at least 15 to 20 years until they need the money. But as you get closer to retirement, you should gradually reduce your stock allocation to lower the volatility of your portfolio. A simple rule of thumb is to subtract your age from 110 to determine your stock allocation. At age 40, that means 70% stocks. At age 50, 60% stocks. At age 60, 50% stocks. At age 70, 40% stocks. This is just a guideline, not a hard rule. Your specific situation, your other sources of retirement income, your risk tolerance, all of these factors should influence your actual allocation. The key is to make this transition gradually over many years, not all at once. If you are 55 and currently have 90% in stocks, do not suddenly shift to 55% stocks. That dramatic a change could lock in losses if you happen to make the shift during a down market. Instead, shift a few percentage points per year until you reach your target allocation by retirement. Fifth, I want to address the impact of taxes on your investment returns. Taxes are one of the biggest drags on wealth accumulation, and minimizing them should be a priority. The most powerful tool for tax minimization is using tax-advantaged accounts like 401k plans and IRAs. Money in these accounts grows tax-free or tax-deferred. Over 30 years of compounding, the tax savings can amount to hundreds of thousands of dollars. Within taxable accounts, index funds have another advantage. They are extremely tax efficient because they rarely sell holdings. They generate very little in taxable capital gains. Active mutual funds, by contrast, frequently buy and sell stocks, generating taxable gains that reduce your after-tax returns. Another tax consideration is the placement of different assets in different accounts. Generally, you want to hold bonds in tax-advantaged accounts where their interest income will not be taxed. You want to hold stocks in taxable accounts where their long-term capital gains will be taxed at lower rates. This is called asset location, and it can add meaningful after-tax returns over time. Sixth, let me share some thoughts on when it is appropriate to deviate from this simple strategy. There are a few situations where modifications might make sense. If you have a pension that provides significant guaranteed income in retirement, you can afford to be more aggressive with your investment portfolio. The pension serves as a bond-like asset, so you may not need as large an allocation to actual bonds. If you are very young, in your 20s or early 30s, you might consider an even more aggressive allocation than 90% stocks. With a 40-year time horizon, you can afford to take more risk and have plenty of time to recover from downturns. Some young investors go 100% stocks, which is defensible given their time horizon. If you have specific knowledge or expertise in a particular industry, a small allocation to individual stocks in that industry might make sense. But I would limit this to no more than 5 or 10% of your portfolio. The core should still be index funds. If you have a very large portfolio, say over $5 million, The calculus changes somewhat at that level. You can afford more diversification into asset classes like real estate investment trusts, international stocks, and perhaps some alternative investments, but for a $50,000 portfolio, these additions add complexity without meaningful benefit. Let me also share what not to do. Do not invest in high-cost, actively managed mutual funds. Do not buy individual stocks unless you are prepared to lose that money. Do not try to time the market. Do not chase last year's best-performing fund. Do not listen to market predictions from television pundits. Do not check your portfolio every day. Do not panic during downturns. Do not get greedy during bull markets. Most investment mistakes come from doing too much, not too little. The simple strategy I have described works precisely because it removes most opportunities for error. There are no decisions to make about which stocks to buy or sell. There are no market timing calls. There is just steady, disciplined investing month after month, year after year. I have watched investors make every mistake imaginable over my 70 years in the market. The ones who succeed are rarely the cleverest. They are the ones who keep it simple, keep costs low, and maintain discipline through all market conditions. That is the formula for building wealth. It is not exciting. It will not make for interesting cocktail party conversation, but it works. Build your portfolio, keep it simple, stay the course, and trust that time and compound interest will do what they have always done. Turn patience and discipline into wealth.